Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither philstockworld.com, PSW, nor its affiliates, nor any of their respective offices, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website www.optionsclearing.com to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously and we will not distribute or sell your information to anyone.
All right, fantastic. Welcome everybody. We've got a hell of a fun day today. I've only got about an hour because I got to get ready to go to this interview on BNN tonight. Let's see, where's the news? Oh man, I don't know. Some days the news feed does not post properly, and today is one of them. Oh well, there are several stupid things in the news. The biggest thing though that's going on right now is that the WHO, the World Health Organization, just declared an actual pandemic today. Now, Goldman Sachs probably knew this. Goldman Sachs this morning said that the market is going to drop 15% more. So you're basically talking about from like 2,800, another 450. So, 24, 23, somewhere in that range they're looking at the S&P going to. And if we look at the long term for the S&P, see what the Goldman thinks is support. Okay, so they're talking about back to here. No brain surgery here. They're saying that we're going to go back to the lows of last year, which really not that surprising. Frankly, we fell that far last year and had a lot less reason than we do now, right? So talking about a repricing, I think that we're in the correct range now. I think 2850 plus or minus 10%. So I'm really not far off Goldman because 10% takes you down to like 2550, 2600. And that's the range I'm using also. In fact, I don't know if this, well, I did it today in the post. So I put up the chart today that I'm going to use on, I'm going to talk about this tonight on the show. Wow, well, maybe I can make a bigger picture. Open a new tab. There we go. So, this was our old must-hold line before we gave up. We capitulated, which we never should have done. I agree. It was just such a relentless rally. We cashed out our portfolios here because I was not going to play the market. We had made a fortune the last couple of years because the market was on a ridiculous rally before this. And coming to Thanksgiving in November, I made a call to cash out all of our portfolios. So we took all of the huge profits and put them on the table. Now we start with new portfolios sometime around here. We started building a couple of new portfolios, and then we added more in January. And the thing is, though, that we weren't bearish, and we should have been more bearish, but it was just such a relentless drive up, and nothing was stopping it. No matter what happened, it just kept going up. And even when they first talked about the virus and had problems, whenever we came up, down, then was straight back up again. So we didn't really follow through, and we didn't keep our hedges heavy enough, and that's hurt us now because we're certainly getting hit hard in the portfolios. But in the grand scheme of things, as bad as this kind of stuff looks, none of that really matters. This is that's a 25% drop to where we are right now. We're down about 25% from the top. That's horrific, and in such a short amount of time. But when you put it into some actual perspective, when you look at a multi-year chart, it's no worse than it was at the end of 2018. We had a similar kind of drop, and it came pretty much right back up. And so, if you're sitting here now and your portfolio is down 25-30%, capitulating is definitely not the best thing to do, because the chance of having more of a correction than this is not that high. And even if you do have a correction this much, which we've had twice in 20 years, right? We had two of these. So even if you have a 40% correction, this is a 60% correction in this case. Well, how much is that? 15 to it can go to 5. So here's a 50% correction basically, and this one was a 60% correction. And now we could easily be heading into this 50% correction down to here, and a 60% will take us back to this spike low down here. All right, but even so, if you even come back 2 years later, there's your 2022 plays right over here. So if you have 2022 plays, the smart thing to do is to adjust them, and when 2023 comes out, you roll them. And I know it sucks, but at least you let time take its course. But getting out, unless they're not good stocks or whatever, is not going to help that much. Now, certain things are going to be terrible, like airline stocks, auto stocks, major purchases people are going to put off, entertainment things, like anything that requires people to gather, restaurant stocks. You're going to have a lot of problems. This whole year is shot for these people. And they're going to reprice it. And the thing is, if this virus thing takes a long time and plays out over a long period of time, even as it starts going away, people are going to be worried it's going to come back, like next year or whatever. And so it's going to be really hard for the market to get back in gear after these horrific losses. Here's where, and again, everybody gets upset if I get political, but here's where having an incompetent government is bad, because there's no sense that the leadership of this country is going to be able to restore confidence in the markets. And that's going to lead to more investor uncertainty, and people are going to go to cash regardless. So we're very fortunate, and we cashed out. Our portfolios were hundreds of thousands of dollars. Our long-term, short-term portfolio was like $2-3 million or something total. And so we're only playing with a tiny amount of what we took off the table, but we're still playing within the bounds of the portfolio. We're not going to, of the new portfolio. So we're not playing like we have 2 million cash on the side. We're just playing it with the regular 500,000. But they do their job. Like the short-term portfolio is already up 100%. It made $100,000 already, and that's only since January 17th. So in not even 2 months, it is now up $100,000. But why? Because that's where our hedges are. These are our hedges. We are, of course, doing fantastically on our hedges. The long-term portfolio, on the other hand, where is the long-term portfolio? The long-term portfolio, especially today, because the VIX is flying up, is down 50%. It's down $250,000. This doesn't reflect the adjustments we made, though, so it's hard to say. But this is down $250,000. So 100,000 of that is made up by the short-term portfolio. So we have that extra 100,000 cash we can now throw into this portfolio, and that will allow us to buy things and to adjust our positions, so that when the market comes back, we're going to have a lot better, deeper, wider positions to come back on. And this, by the way, this thing was down, this is down $100 and something thousand today. So it's really caused by the VIX, because in the long-term portfolio, we sell. There's so much sold premium here that when the VIX shoots up like it is today, it looks like crap. But that wears off pretty fast. I mean, look at the VIX. Jesus. Wow. So that the VIX is now as bad as it was back in the 2008, 2009 period already. And we aren't even, we're just at the beginning of falling apart the way things are going. So that's kind of scary. Look at that. This is why I don't short the VIX. You got a lot of people love to short the VIX when it goes up. And I'm like, well, one day it's going to do that. And that's exactly what it's doing right now. It's just flying up so hard that everyone gets burned on their VIXs. It'll be good to short soon. I'll tell you that, though. You can short the VIX. Once it gets over 50, 60, as long as you give it a couple of months, you can short it. But things are nuts. But this, in other words, so half of the loss of the long-term portfolio is caused by this. When the VIX comes back down below 30, that the long-term portfolio is going to calm down. But what do we do now? We take advantage of this. That's what we do. We take advantage. This is a half price sale for our long-term portfolio. We still have $433,000 of cash, and we're using only $200,000 of margin. We have $1 million of buying power in this thing. We're using none of it. We have 80% of our buying power is available to us. So obviously that's a horrifying thing when you look at something, you're down 48% on paper, that's awful. But you got to realize you're not really down 48%. You're only down 48% because all the short calls and short puts you sold have jumped up in price. But that's not a long-term problem. This is an opportunity for you to buy and do something with. In Viacom, like I said, though, we've already made adjustments to these, so this isn't really the right prices. Hopefully we're doing a bit better than this. But now is a fantastic time. Now we're finally going to be able to establish an Apple position. Now we'll be able to establish a position in Boeing that we've been putting off because it was too high. This is a time to, here's WBA is not even down. Really? That can't be right. Oh, no, there it is. Okay, I was going to say everybody's down today. So, here's WBA coming back on sale. We have a watch list and there's a ton of stuff on it. Look at Boeing, $200. Holy cow. But this is a buying opportunity now, finally. When it was at 300, I was telling people, well, it's 300, but it could get a lot worse. This is quite a bit worse. And still, I don't think I'm going to jump into Boeing right now, but now's the time to start looking and thinking to yourself, hey, where do we like Boeing? This is the perfect time to start making a list. Oh, we can go all the way up to June. Oh, no, not yet. All right. They're thinking about the longer puts. So Boeing's at 199. You can sell the 150 calls for 30-something dollars. The 150 calls for 32, 33 bucks. You can sell the 120 calls for 20 bucks. That's net 100. Okay. I didn't know what to say about that. I mean, you could buy Boeing for net 100, $100 for Boeing. It was like $400 last year. Yeah, they screwed up, but they're not out of business. There it is, 400 bucks. Not last year, October, a few months ago. Yeah, I mean, they screwed up, but 75% of the company's value screwed up. Like they're never going to be in business again. And that's the point, isn't it? Because here's Boeing. You got to get the emotion out of the thing, and especially with the stocks you own. And you've got to just say, okay, so Boeing, what do we got? Oh. What is this? Stock report. There it is. Okay, that's what I like. So here's Boeing. It's a company that has generally been making, $5 billion, $8 billion, $10 billion in revenue. This year, $2 billion. I don't even see how they're going to make $2 billion this year. I don't even believe that number. I don't think they're going to make $2 billion this year. I don't know where that's coming from. But in any case, they are capable of making $5 to $10 billion a year. Okay, they can make it. They aren't making it right now, but they can make it. And I can buy Boeing right now for $130 billion at 200 bucks. If I sell the 120 puts for 20 bucks, that's $100. That would be $65 billion for a company that in a horrific year, people are saying 2.3 billion. Realistically, though, in a normal low year, even if we assume that they never recover here and they go back to 5, in a regular year, they'll be making $5 billion for my $65 billion investment, and they might make $10 billion on $65 billion. They might make my money back every 6 years at that pace. That's assuming no growth, no nothing, no big recovery, no bailout, nothing good happens for them. And still they're going to sell some freaking planes. Even if they have to scrap the 737, take 2 years off and start again, they still are going to sell planes again. They got a hell of a lot better chance of selling planes than any other company out there other than Airbus or Bombardier or somebody like that. But basically, you know, as far as wide body jets, Boeing are the guys. And obviously it's a bad year for the airlines. But if you think about it, Boeing's got 7 years of back orders, right? So even if an airline has a terrible year, if you're the airline that's supposed to get deliveries this year or next year on your planes, and Boeing says, okay, we're ready to fill that order now, are you going to say, no, thanks, I've changed my mind, and then get back into the back of the line and wait 7 years until you can get new planes while your current fleet that you were supposed to be pushing out the door is getting older and older and older and requiring more and more maintenance problems and not getting the fuel efficiency you need and so on and so forth? No. They're not going to lose their customers. Their customers have been waiting all year for their deliveries. So the 7-year wait turned into an 8-year wait for the people in the back of the line. And the people in the front of the line can't wait to get their frickin' planes. You know, now Boeing really screwed up and has major problems and so on and so forth. But you know what? On the whole, they do know how to make planes. They've made pretty much all the planes on Earth. You know, probably 75% of all planes on Earth are Boeing planes. So they've got a 50-year record of making perfectly good planes. They made a bad plane. They did make a bad plane, but it doesn't mean they can never make good planes again. They just go back to the last plane they had, which everybody liked. And I said this 2 years ago. I said it's a flawed design. If it's a flawed design, you gotta cut bait. You can't keep pushing it out through the door. And that was the problem, is they insisted on putting out a plane that they never should have put out, because once you commit to making it, even if you realize there's a problem down the road, they put in a software fix instead of just saying, you know what, bad idea, we got to stop this plane. That hit, taking that hit properly 2 years ago would have saved them hundreds of billions of dollars now. You know, but nonetheless, whatever, you know, I mean, it doesn't really matter. What matters is, how could you not buy this thing? And not for $200 billion. I'm not saying buy Boeing for 130, sorry, not for 130 billion. I'm saying that we can use options to buy Boeing for $65 billion. We can sell the 120 puts for $20, or we could sell the 150 puts for $30. I think I'd rather sell the 120s. So given that, I'd rather sell 15 120s instead of 10 150s. But holy crap, I mean, that's, so in other words, if we sell 15 of those in the long-term portfolio, that's $30,000. That's $30,000 we get cash for selling 15 of those puts, and we're committing to buy at 120 times 1,500. What? That's not right. $120 times 1,500, 180,000. There you go. That's a little better. So we're committing to buy $180,000 worth of Boeing stock in our long-term portfolio, which has $1 million worth of buying power. So if Boeing does keep going down, Boeing would represent a substantial portion of our portfolio, which we wouldn't do. So in reality, we don't really want to own it in that quantity. We would have to stop out, but we need to know that going into the trade, that if Boeing does go bad, if it fails to hold 200, we need to rethink it and possibly take at least half off the table or something like that. But it's not a deal killer, because it's still not going to go down to $120. You know, it's just, we just don't want to be into a position where we're forced to take a loss if it does go down to like 150 or something like that. We don't want to have to capitulate. So rather than capitulate, we'll take a quick loss on 5 or 10 of them, and we'll leave the rest in, and we'll get our money back. But to turn that down, to not take Boeing at net $65 billion when they made $10 billion last year, not the ancient history, last year they made $10 billion. This year's the year they're screwing up. So, and there's deals like that all over the place, but you got to look at your blue chips and see who's ridiculously cheap. Exxon, $42 for Exxon. 42, I don't know what that market cap is, but it's not much. You know, that's what we got to do. You got to go through. So the watch list we had was a watch list of stocks that were not, you know, at the time. But now our watch list should be blue chips, right? We had a watch list, but that watch list was based on a whole bunch of overpriced stuff when we were bargain hunting. Now our watch list can be these blue chip stocks. Exxon, 108, like really 183 billion. They were almost going to be $1 trillion company at one point. They're 183 billion dollars now, and these guys make $20 billion in a good year. They made $32 billion in 2014. They made $10 billion in a bad year. In 2016, they made $10 billion or $8 billion. 183 billion, you can have a whole thing. Crazy. And again, same thing. You go to Exxon. And I don't have to make a big commitment here. I just say, Exxon, let's see. Okay, I'll buy 1,000 shares for $42,000 at, oh, how much will I pay for Exxon? Let's see if we can get half. That'd be like 20 something bucks. Yeah, it's not fun. No, I wouldn't do that. I would sell the $30 puts for $4. So then I'm in for 25 bucks. It's like 40% off the current price. So you're in for 25, 26 bucks. You sell the $30 puts, sell 10 of those. You collect $4,250 just for promising to buy Exxon if it gets to 30. And the net for you would be 23.50 if that's the case. I mean, these are ridiculous prices. And again, if the market goes even lower, you want to have an amount of puts that you don't mind doubling down on. And also, if the market goes lower, we're going to buy a bull call spread to go along with the short put, right? But if it doesn't go lower and we say, oh, look, I got these puts in these 5, 10 different stocks, we've got puts on them, we're going to do this by the end of the week. Even if the market is still going down, we're going to sell some puts. We're going to, you know, when the market goes lower again, we're going to first look to see what do we have to roll, what are we worried about? And when we look at a put and say, well, I'm not worried about that. Like if Exxon goes down to 35 bucks and we sold the $30 puts and we say, well, 35, that's just ridiculously silly for Exxon. Then what's the next step? Well, then we say, well, since we think that's completely ridiculous, now would be a good time to buy the 25, 40 bull call spread, which is currently like 18 minus 8, so about 10. Well, I wouldn't do that because 2 is not enough of a discount. But I'd find something like, let's say the 30, so that's like 14 minus the 30 and 45 is not. No, these are, I don't like the prices. Oh well, I guess I wouldn't do that. So in Exxon it doesn't work. But if in a regular stock, I would try to find a bull call spread that at least pays me 2 to 1. If it doesn't pay 2 to 1, I wouldn't do it. But we would find a bull call spread that pays like 2 to 1. And whoops, just broke this thing. I was playing with something, I broke it. And we turn it into a bull call spread. So Exxon, I would say, no, forget that. That's not good prices. Or, you know, sometimes something gets so crazy low that you want it anyway, but Exxon would not qualify for me. Caterpillar would, though. Let's say if Caterpillar gets stupidly cheap. And again, like Boeing, half of the major equipment in the world is Caterpillar equipment. It's not like people are, nothing happened here that made Caterpillar a bad stock. The global economy is taking a turn down. People are panicking out of stuff. So Caterpillar has gone down to $60 billion, even though they made $6 billion last year. Okay, maybe they'll go down. Maybe they'll make zero. See, they made zero in 2016 and 2017. Not like they're not capable of not making money when the market slows down. They could go down to 3 billion, but you know what? 60 billion, even if they're making 3 billion, I don't really mind that much. And also, I'm going to pay, no, I'm not paying $60 billion. I'm going to promise to pay, what are they at now? 102. So I'm going to sell like these, blah, blah, blah. I'm going to sell the $65 puts for $750. There you go. right? You sell the $75 put, $65 puts for $750. You're into like 50 something bucks. You know, 57.50 basically. So will I pay 57.50 instead of 102? Will I pay half of that for Caterpillar? Of course I would. Because they're the biggest construction equipment manufacturer on the planet Earth, and that's not going to change. And it's not like, especially in a recession, it's not like somebody's going to come up and compete with them, right? Nobody's going to invest hundreds of billions of dollars to beat Caterpillar out of the market in a recession. When things start coming back, they're going to have an open field. Also, they're going to have a better ability to reconfigure themselves. They've got a better ability to borrow money and to buy out their competitors who got hurt by the deal, but to make better, because they're Caterpillar, they go to their parts supplier and say, hey, guess what? We're happy to give you guys more cash, but you're going to have to give us a better discount on the parts because times are tough. And they'll push all their subsidiaries to make better deals with them. All right, they'll make better leasing deals with their customers. They know their customers don't have money, and Caterpillar can afford to like give you equipment up front in terms for lease financing and things like that, where they'll actually make more money over time. These are the companies you want to be investing in a crisis. But again, I'm not rushing into it because you got days like this is still happening where we're dropping 5% a day. And remember, although 5% is horrific. And a 5% drop in the market means that there's a lot of stocks that are dropping 10%, which is essentially limit down for the market. So that's why there's a 5% rule. The 5% rule says a major index is not very likely to lose more than 5% in a single day. And we've seen that happen 4 or 5 times now in the last couple of weeks. 2.5% and 5% drops on major indexes are rarities. But we're pushing right up against it right now, and another 5% drop today. You know, so but that basically means that the market is falling outside of obviously, you know, crazy stuff like the circuit breaker thing this week. But in a general market move, 5% drops are as much as the market's going to have in any given day, and that means that that you're going limit down. It's not officially limit down, but you're basically going limit down on the market on an almost daily basis. We're nowhere near finding a floor the way this is going. So Goldman's probably right. We're probably going to fall off further, but that doesn't mean that that price is right. It just means that's how far we're going to fall before people start buying again. So there's no sense rushing into these things, but I'm already looking at stuff and I'm salivating over the pricing I see. $10.20 says, Phil, have you been on Bloomberg before? I'm on all the time. That's why we have a money talk portfolio. It's Bloomberg Canada, BNN in Canada. It's BNN Money Talk is a show, 7 o'clock. And I'll put a video up tomorrow anyway. And Roger says, you mean selling Boeing puts, not calls? Yes, I did mean puts. If I say calls, I apologize. But we're talking about puts. So that goes for any major stock, though, okay? And again, don't forget, I've only got about a half hour more to go here. That goes for any major stock, though. You want to look at, first of all, you got to take care of your portfolio. So let's talk about that. You've got to make the adjustments. So there's a series of events that we go through in a market sell-off like this. And the Money Talk portfolio, oh, forget that. Let's go to the where I wrote this morning, because I wrote it all down already. So step one is you take your portfolio, and in this case, it's our Money Talk portfolio, and you analyze each position, and you say to yourself, damn it. Let me move that. Are you kidding me? I can't. Oh, there it is. All right. There's a thing you probably can't see, but it's like totally in my way. It's like a control panel for the thing, for the webinar. So you look at your positions and you say, okay, first of all, this is a key to our portfolio. Cash on hand, $99,000 in a $100,000 portfolio. Okay. The value of the portfolio, the position values are -7 because we sell a lot of premium, so we got screwed there. But the bottom line is it's only worth $91,000, but $99,000 of our value is cash. The positions are worth negative at the moment, but fortunately we don't have too many of them. And if I remember correctly, we have a minimum amount of only $8,000 in margin being used. That's ordinary margin. So we have tons of spending power. We have a couple $100,000 of spending power sitting around. We have a lot of cash. So now I say, okay, I don't want to go crazy, but I want to now, since the market's down 20%, I want to make sure I'm repositioning. My positions need to be able to realistically make money. So I look at SunPower, and SunPower, we sold the $8 puts for $3. That's net 5, and they're at 687. I'm not worried about that. I think it's a great value at that price. They're only even down 12% anyway. So I'm not worried about that. There's no reason to buy more, double down. But what I can do then is, and I said here, we sold the $8 calls for 310. We're net for 490. We're not in trouble, but we're going to take the opportunity now to add the 2022.5, because it's all the way down here at 687. We're going to add the 510 bull call spread for $1.80. Now, $5, it's a $5 spread. I get to pay, I pay $1.80 for it. So my upside is 320. That's a significant upside to that thing. So it's a good use of my money. How much am I spending? I'm spending $3,600 in cash to make, well, it doesn't say that, to make $6,400. So almost 200% back on my cash. I'm sorry. But we paid net 500. Huh? Why am I? That will. Oh, I see. Because if you subtract, I'm sorry. So if you, I did do the math. So if you subtract the 3,100 we sold the puts for, we just did this in an extended period. We first sold the puts for 3,100. Then the stock got so cheap that we decided we're going to buy the bull call spread. We were buying the bull call spread for $3,600, and that means the whole thing cost net $500. And it's a what? It's a $10,000 spread. And it's a $10,000 spread that at $7, if it's still at 7, no, at $6, it's dropped heavily actually. At 628, it's still $2,500 in the money. We paid $500 for it. Now, of course, we have the what puts? We have the $8 put. So if it does stay at 6, we'll get a sign, but we'll just roll it and deal with it later. That's not. I'm not really worried about that part of it. But even so, it's like, yeah. And on the spreadsheet, it's a net $3,500 cost to us right now. So if we turn around and we make 10,000, if we turn around and cash this spread out now for $10,000, that's going to be a huge net increase in the portfolio. So in this case, $9,900 we can get back on this trade. So that's a good adjustment. And do we think that 10 is an unrealistic price for SunPower? No. It can easily get back to that. It's got 2 years to get there. This is silly. We know it's not being sold off because anything happened to SunPower. It's being sold off with the entire market. And you know what's weird about the solar companies too? SunPower sells off in the energy sector because sometimes it's in an energy ETF, sometimes it's in a chip ETF. It sells off with the chip sector. It sells off with the semi sector. It sells off with the tech sectors. So there's so many different ETFs that have SunPower in it, and they're all crashing at the same time, that of course the stock gets dumped. Because this is the thing about ETFs. You know, you guys have all heard this. So much money has poured into ETFs during the rally that are just blindly buying. Like the market went to be like 75, 80% ETF buying and very little actual trading. So the problem is when you have a sell-off like this, the ETFs indiscriminately dump. So in other words, when you sell your QQQs, every stock in the QQQ gets sold, right? The QQQ index has to sell all in a proportion, all of its holdings of each stock that it has. When you sell one QQQ, you cause 100 stocks to be sold inside the QQQs. They're just dumped. Now, if all the indexes are selling, right, that's happening over and over and over again, and all these stocks are being dumped. But the problem is, how is that stock not going to go into free fall if no one is specifically buying SunPower? So the selling in the indexes overwhelms the individual purchases of the stock and causes them to go into free fall in a manner that has nothing to do with the value of the stock, has nothing to do with logic or anything else. It's a massive inefficiency in the system that we can take advantage of. And we take advantage of it by keeping a cooler head and looking for these opportunities. And it's really hard to do. I know it's hard to do because it's very hard to look at a portfolio that's down 40% and 50% and say, oh, now's the time to buy. But now is the time to buy. And I'll tell you back, we had the same thing back in oh wow, I wish I could get that list. I bet I can find that. Not today, I'll do it tomorrow. In the 2009 crash, in March of 2009, I wrote up a list of 13 stocks. In fact, I was on a TV show. And we picked 13 stocks in 3 hours on a TV show that made an average of 350%, with options, but made an average of 350% over the next 6 months, an average on the picks. Because exactly what we're doing now is just taking the stocks and saying, that's ridiculous, that's ridiculous. But it was things like GE and Ford and Cisco and things like that. I mean, we were taking the bluest of the blue chips, AT&T, things, like Viacom right now. Holy crap, I can't believe I forgot that for the Money Talk show. Viacom, oh my God. VIAC. Look at that. It's a freaking TV network. What about the coronavirus is going to cause a TV network not to make any money? I mean, yeah, maybe ad revenue might go down a bit in a recession or something like that, but come on. I mean, that's just insane. These are the kind of opportunities you have now. This is why it's so fantastic that we've got so much cash on the side, but only if you're willing to pull the trigger and do it. And this is where, this is where the advantage of being a value investor is. I'm a value investor. I don't care about things like, I don't care about what the chart looks like or anything like that. I'm saying at this price, I want to own Viacom, no question about it. And we already have Viacom, so that's probably why I didn't think of it, because we already have it. It's not on my list. VIAC. But Viacom's another one. Got to January 2022. The stock is currently at $20. Look, the options don't even go that low. I mean, you can sell the $20 puts for $6. You can sell the $15 puts for $3.35. That puts you in at like, what, $11.80, like $11.70, $11.65. So $11.65. Another 40% off the current price of Viacom. Why would you not do that? It doesn't make sense not to do that. It's just, the problem is just what's the margin. But you have to go through your portfolio. See, what you have to do is an exercise. You got to go through your portfolios and say, what's eating up too much cash and margin? Okay, because maybe holding on to Apple is preventing you from buying 10 sensible stocks like Viacom instead, where you can actually leverage your money a lot better. You got to think about that also when you're reviewing your portfolios. Like, some things are sucking up too much cash and margin to be worth holding on to. And unfortunately, the way we were buying things, we were already thinking about that before. We kept a lot of cash on the side and a lot of margin on the side because we expected to sell off at some point. And now we're having it. So time to jump into action. This is the moment we were waiting for. But again, I'm not gung-ho. Step number 1, improve the positions you have, providing you still believe in them. So back to here. We did 1 so far. Let's see if we can do 2. Freeport-McMoRan. Now, why are they going down so much? Again, indexing. They didn't do anything wrong. They have gold, they have copper. Copper is down, but not severely down. Copper is really not much worse off than it's been for the last few years. Go to copper, go to metal. Freeport is 60-70% copper, and the rest is gold. So here's copper. They're at 250. Look, they were lower than that in 215 and 217. This is not a surprise. FCX. So look, they've been down here before. In 216, they were down this low. They survived. They came back. They went all the way down to 5. So if you're buying them now at 8, you better damn well be ready for 5. But you know what? How long does this really last? Here's 12-15, and here's March of 16 already. They're completely out of their slump. They started going down in October, and by March, so in 6 months, the whole thing is erased. So maybe they'll go down for another couple of months and then they'll be erased again. But if you're not buying down here, if you're gonna, you don't jump in here and say, oh, if it goes to 5, I'm just gonna cry until it comes back. You've got to have a plan that says, I'm gonna scale in. I'm gonna buy at 8. I'm gonna buy more at 6. I'm gonna buy more at 5 or 4. I don't care, because I want to own a lot of Freeport at that price. So we already bought some. And we didn't get a bad price because we bought the 10-15 spread, and we were okay. We paid net $2 for the spread, and the spread is now net $1. So we got a little bit hosed there, but that's okay. And we sold the $12 puts, but we sold the 12 puts for $2.50. So our net is like a little below 10, $9.50. It's at $8.20. This is not a big deal, but we take advantage of it and we say, okay, our $10 calls are $2.68 and the $5 calls are $4.70. So we're going to roll. We're going to spend $2 to gain $5 in position. So that's what we're doing. We're not doubling down. We're just spending $2 to gain $5 in position, rolling our calls from the 10s to the 5s. All right. We're still keeping the short calls, I think. Wait, did we? I don't remember. Anyway, yeah, I think we kept the short calls. But we're still keeping the short calls. The short calls are way up at 15. Okay, so when next time it gains, the short calls aren't gonna hurt us, and we could gain a lot more money on the way back up. So that's what we do first. We're not ready to double down yet or anything fancy like that. We're just doing that. Then gold. Well, gold is obviously, that's Barrick Gold. They're all gold. I mean, they do sell copper and molybdenum. I can never get that word out. They sell copper and moly. Moly sounds like a drug, though, isn't it? They're in good shape. Unfortunately, they're really not as good a shape as you would think, right? They should be up a lot more than this with gold at the price it is. But they're just getting, again, like everything else, they're just getting sold off regardless. The ETFs are selling. They're in the S&P, so they're selling. Whatever index they're in is selling. People are dumping the index. Therefore, every stock in the index is getting dumped. Doesn't matter what it is. And unless the stock has specifically people buying it directly, because the indexes are getting sold, so unless individual people are specifically going to that stock, gold, and buying it, the stock is going to go down with the market. Not on any merit whatsoever, just based on the fact that it's in indexes and the indexes are getting dumped. That's what's happening right now in the markets. Anyway, so gold, well, this one's way in the money. The gold trade, we have the 13-17 spread, because we bought that way in November, and we were super conservative. So we bought it when it was down here. We bought the 13-17 spread. We were very conservative in our entry, so we're like way over it anyway. So all we're doing is just waiting to make the money. IBM, freaking love IBM down here. Can't believe it's this price again. That's another one for the list. Another one where you take the put. I should have done a different presentation for the money talk. I think I should have done this, because this is like really important stuff. So IBM's at 120, and you know, I'm gonna think about how much money they're making right now. IBM's at 120. You can sell the $80 puts for $7 with IBM at 120. That's going to put you in there at $73. That's like 50 out of 120. It's got to be 30-something% off, 35% off. IBM. This is what I mean by blue chips, though. This is a joke. There you go. They made $10 billion last year. Their market cap is now $110 billion, which is basically where it is. So we're talking about netting in for $75 or $65, whatever the frick it was. If you're netting in for $70 billion, they make $9 billion per $70 billion. And they were projected, until this crisis, they were projected to go to $12 billion. And you can net in for $70 billion. Okay? If you're not doing this, why are you even investing? How is it investing if you're not making these trades? I'd like to say it's once in a lifetime, but it's not, because it happened in 2000 and it happened in 2008 and now it's happening in 2020. And I guess it's going to happen in 2040 again. I mean, there'll be some other thing that causes all this to happen, but so what? That's how we make our money. That's what we take advantage of. I mean, this is just crazy stuff. And yes, it might go lower and we'll roll it again. But right now we have a position and we're going to buy. Here's where we're buying back the short calls for 60. Oh, that's IMAX. Sorry. No, it's not IBM. I was going to say, it doesn't make any sense. Too low. We're going to roll our 120 calls that are 1770, which are lower now, to the 110 calls at 22. We're going to spend $5 to roll down 10 in strike. You see the theme there? I'm always happy to spend 50 cents to make $1. But that doesn't work unless you have it on the sidelines. And we do, because we have a reasonable portion size to IBM. We have only 8 longs. So when I say we're going to spend $5, that's $4,000 that we're spending to roll, but we're going to pick up $8,000 in strike. I could still double down. It's still not that expensive for us to double down. But we're not at that stage yet. We're only at the rolling stage right now. So our first reaction is to spend $5 to make $10. Anytime I can spend 50 cents to make $1, that's our first step in the roll. It doesn't matter if IBM goes lower, because what's going to happen? I'm only going to spend another $5 to roll another $10 down. Okay, and that goes back to what we were just saying about, well, you know, that goes back to this long-term thing. I don't know that it's not going to do this, but if it does, it's almost certainly going to be, okay, either it's going to be a short-lived drop like this and it's going to come back quickly, or the world's ending. So if the world's ending, my portfolio loss is not my concern. So, you know, unless, you know, in other words, I mean, just think about this actually happening and staying that low and going lower and being like that, and that you're in a depression. At that point, you have way bigger problems than losing money on IBM. But obviously, that would compound your problems, though. It is much more likely, though, that we normalize. And normalize, frankly, for the indexes, normalize is probably right about where we are now. But again, that's what I've always said. 2850 is probably more the right price for the S&P. We're 100 points below that now. We could be 200 points below that by the end of the week. But what happened today? Keep that in mind. What happened today is Goldman Sachs said we're going to drop 15% more. So here we are, 5% down. Goldman Sachs said this. They told their clients 15% more drop. That means everybody's playing it that way. And everybody listens to Goldman Sachs, so people all over the world are dumping stocks. We're not dumping stocks. We're taking the stocks. Well, we're taking the stocks we have and we're saying, okay, good. Well, in that case, we'll take a position 10% lower. We'll drop our strike 10% to match. So if it comes back quickly, great, boss. If it comes back slowly, we'll start selling calls, but at least we have a low enough position to start making some money on them. You want to stay in a position where you have a good chance of coming back and where you're able to sell calls and create an income stream if it's going to be a prolonged downturn, which is doubtful. The virus is probably going to go away. The markets are going to recover. There will be some massive stimulus. Trump is floating $1 trillion stimulus plan. Not going to happen, but you know, that's one. And another reason we're down is because of that. Because he instead of proposing something reasonable and sensible that Congress would approve right away, he proposes something completely ridiculous, like let's go another $1 trillion into debt, and half the money is going to go to corporations, and mostly large corporations that have millions of employees, where they don't have to pay the payroll tax anymore. He's not just saving the payroll tax for the employees. He wants to have the corporations no longer contribute to the Social Security system, which will then go bankrupt another 5 years earlier than it's already going to go bankrupt because we didn't make the contributions. It's an insane plan. It makes no sense. And our debt's going to go up 5%. National debt, 5% added to the national debt, another $1 trillion in debt. You know, I cut that picture out this morning from the national debt clock. That's from the national debt clock. This is the government's tax revenues. This is all the government's tax revenues. 1.7 trillion in income, 1.3 trillion in payroll, which he wants to cut, $235 billion in corporate taxes, nothing out of the grand scheme of things, and 67 billion in tariffs. He didn't cut that. He won't cut that, but he'll cut this. Why? Because this is being taken from the people. Half of this money is being taken from the corporations. They pay the payroll taxes. I mean, it's really being taken out of your paycheck. So, you know, the corporations don't consider it their money. It's money they were going to pay you, but it got taken out in Social Security. That's just part of the salary plan. But that's a trick that they try to convince you the corporations are paying. Oh, there's all the news. Now all the news came out. All right, very good. So who's saying stuff? Nobody's got comments. Why do you think SKT is being crushed? Again, Brendan, REITs, because they're in the REIT indexes, and the REIT indexes are being sold off, and they're getting just thrown down with it, and nobody's got a reason to buy SKT. Nobody's, you know, it's not popular enough to have buyers. So the indexes are just flooding sell orders into the market, and if this many people, like the volume of SKT, I bet there's probably high volume. It's certainly not high volume because there's news or anything. Yahoo. SKT. Oh my God, it's almost 2 o'clock already. How did this happen? So here's the data. Well, no, it's not really that bad. Wow, look at that, 48 million. That must have been their earnings. Honestly, the volume's actually not that big. So five, you know, here's 5 million. Yesterday it was this. So, you know, that's a biggie, right? I mean, all of a sudden doubled in volume. It's not because there's any news on SKT. They didn't do anything today. They didn't announce anything. They're just getting sold, and that volume it's overwhelming any potential buyers. Look, Tangier has strong demand for the Antioch Mall. That was yesterday. Okay, and they're not lying. They've got 96% capacity, like they always do. There's nothing bad has happened. The clients that they have are not going bust. They've got a strong client base. They have no clients that are like more than 10% of any of their malls. So even if certain clients go bust, they're very strategic about that, because they've over the years they've been concerned that you can get killed because one big client goes bust. So they don't let themselves rely on any big clients. A brilliant strategy. It's a great outlet mall. They've got a great diversified group of stores, and they're always almost fully occupied. It's you know, you go to any of their outlet malls and you'll hardly ever see an empty store, unlike every other place in America, basically. But that doesn't stop them from selling off, does it? That's if the indexes are dumping REITs, they're a REIT. They're going to get dumped. And if there's no reason for 5 million people, or whatever the volume is today, volume. I don't know. There, volume 5. Yeah. If there's no reason for 5 million people to be buying it, that means every time the overwhelming amount of selling hits the wire, it drops to the lowest bid, drops to the lowest bid, drops to the lowest bid. That's the other thing about indexes, is when they dump, they just sell at market. They don't put limit orders in. They just sell at market everything they've got. That's why investing in ETFs is a stupid thing to do generally. It works out fine over the long haul, but in the short runs, you can get really burned. That's why I cashed out my kids' college plans. I've been telling you guys this since the summer. I cashed out my kids' college plans because we had a fantastic run, and their colleges are fully funded, and it made no sense at all to risk their college money on the market. It's like, because I'm like, even if it makes 20%, the government in those college plans, anything you have left at the end, the government takes 50% tax on. So my upside is extremely limited on it. And my downside, if they could lose, like right now in the ETFs, they would have lost one quarter of their fund would have been gone, because you can't really hedge them. All right. Instead, I'm now looking for a chance to jump back in with my kids' college funds, and now they can make some bonus money, because I don't feel like I'm going to be risking a semester, not a semester, risking a whole year of college on the outcome. You know, and that's a decision you've always got to make with your money and your portfolio and such. And it's like, you know, and I've been saying it since the fall, basically. Like, this is not a market you want to risk a lot of money on, and our portfolios have been very very conservatively invested because of that. We've not conservative in the positions, like we're not doing anything, but conservative in that we're risking very little actual capital, so that we have a lot of money on the side, so we can do what we're doing now, which is adjusting. So where were we? Did we get to IBM? Yeah, we got to IBM, right? So IBM's roll down. IMAX, same thing. We're going to buy back the short calls because I think this is just a bottom. I think this is a real bottom here. These guys are going to get bought at this price. This is insane. They're going to buy back the short calls, so we have it just in case they pop. We don't get trapped with the short calls. We're going to add 10 more $15 calls. So I think we had 20 and we're adding 10 more. So we're increasing by 50% in this case. Oh, and why is that? Because there's not a good roll down. All right, that's why there was a decision made on IMAX. Whoops. So the September 15th, there are no 10s and there wasn't a good roll down. So let's say these are $2 and the 13s are like, they're not 460. The 13s are like $3. And it's not worth doing the roll. And also, by the way, you have to take into account when you're getting this granular with something, the 15s are going to be a lot more liquid than the 13s. So anything 5, 10, 0, anything like that is going to be a more liquid thing to trade. And so you don't want to really be trapped in an illiquid option with small traded stock, because it makes it hard to get in and out of. So it wasn't worth it. But buying back the 20s, turns out like 50 cents got bought back for. That's a good deal to buy them back because we sold them for a couple of bucks. And the 15s we're going to leave, but since they're so cheap, we're just going to add 10 more. We're going to increase by 50%. When the 10s come out, we're going to be happy to roll. When January comes out, we'll be happy to roll to January, whatever. But right now, there's no good option there, so I'd rather just increase the position in general. And also because IMAX is so cheap now. IMAX. Yes, you. No, why does it do that? IMAX. They ain't do it too fast. So IMAX, this is less than $1 billion for IMAX now, and they were making. Where is your profit? Okay, so they're making like 50 billion. They're on a track to make about $50 billion a year at this point. So they're coming down to a real point, but they have incredible growth, and it's going to be interrupted this year, of course, but they'll get back on the track, and they've got incredible growth. So as a long-term position, these guys are fantastic. And we definitely want these guys for the long haul. This is an incredible opportunity to get a cheap entry on the stock. So overall, we were down 8.4% this morning, and now we're down, what, 14%? 14.5%, so dropped 6% more today. Or more than 50% more than it was this morning. That's how much the VIX changed and things changed on the indexes. So that's bad. Wait, what happened here? Oh, okay. So then what I say, so once you've decided what you're going to do with your existing positions, I said, look, well, how much did we spend? We spent $14,540, and we had $100,000 sitting around. So we still have $5,000 left to spend on other stuff. That's plenty. Not worried about the positions. We have a potential to gain $56,590 in the existing positions. That's very nice. And we feel good about all of our positions. We checked every single one. But now I'm saying, okay, so now let's go to our watch list and pick a few things that we want to add. And in this case, no, we didn't have SKT. Okay. So in this case, I'm adding Valero because it's silly. It's a refiner. They're going to make their money on the spread. The difference between the price, they're buying oil and turning it into gasoline. So it doesn't matter what the price of oil or the price of gasoline is. What matters is how much money they make between the price of oil and the price of gas. So if they're buying oil for 20 bucks a barrel and there's 42 gallons in a barrel, that means that they're paying 50 cents a gallon for gas. As long as they sell it for $1, they're in good shape. It doesn't matter to them how much the price is. You know, Valero, you know, and again, it's like you gotta look at this in see, I could do this all day, actually. It's so much fun stuff to talk about right now. Yeah, what happened? Wait, Valero Energy. There it is. Okay. So Valero. Now, let's look at gasoline or the oil, energy. See if I can find a U in oil was really bad. Oh, here you go. All right. So 2015, so basically 2015 and a half to 2016 and a half. So basically, let's say the year 2016 would be indicative for them, or the year 2015, 2016 would be indicative for them. In fact, 2016, no, sorry, 15. 2015 kind of started like this, and then died out really badly at the end. So I would say if you look at the beginning of 2016, you see, get an idea where they are. But let's see where that was money-wise for Valero. So in 2016, 15, they still made $3 billion a year. Okay? Oil was way down there, and gasoline was way down here too. $1 went up to $1.50, but it started out, it was $1. It's on early in 2016. All right, and they still made $3 billion. Okay, they didn't make as much money as they made in, you know, they didn't make as much money as they made the year before or whatever, but they made, well, here you go, they made 2.3 billion in this year, but then the next year they made 4, then they made 3, they made 2.5 last year, even though gasoline was kind of expensive last year, only made 2.5. But they're good for at least 2.5 billion. It'd be very funny for them not to make a couple of $1 billion, and you can buy the whole company for $24 billion right now. And I'm not saying that. I'm not saying to buy it for $24 billion right now. I'm saying sell the $40 put. They're at 54. You sell the $40 put for $7.50. Well, they weren't at 50, they were at 60 this morning. They're at 54 now. Sell the $40 put for $7.50. That nets you in for $32.50. That's 14, 12, 22, sorry, $22 off the current price, 40-something% off the current price. So you're paying not 24 billion, but whatever 40% is, like 8-9 billion less than that. So you're paying about $15 billion for a company that could easily make 3 billion and is almost certainly going to make a couple of $1 billion. Why would you not want that? Is Valero going to go bankrupt? No, it's sad. They've gone through this before. This is no surprise to them. What's it all look like on them? Here they are in 2008 when everything collapsed and they were at $15. Here they were in 2009, 11, 2000 here. Okay, they were down, they go back up. They're down, they go back up. Now, maybe we'll be unlucky and they'll go down and down. But if you plan on it and you say, okay, well, good, I'll buy some here, I'll buy some more here, I'll buy some more here, I'll wait 5 years, and then I'll make a fortune. That's what investing is about. Everything's not going to come back tomorrow, but it's not everything is going to die tomorrow either. So that's what we do. Blue chips, sell. SKT, like we were talking about before, SKT, you can sell the puts. I don't care how low it goes. I don't even care if we get a sign. We want this stock. In this case, I said we buy it for 10.40. It's already $1 lower. I mean, this is crazy stuff. Ford pays a 60-cent dividend on a $6 stock. That's 10%. So they aren't even really in trouble at the moment. Because again, this is nothing Ford did. This is a freaking virus. It might slow business down for a quarter or two, just like any recession. Ford has been around for 100 years. They've seen recessions before. These companies know how to deal with this stuff, mostly. I mean, they almost went bankrupt once. I mean, everybody almost went bankrupt in 2008. It's probably not going to be like that. This is probably going to be a 3 to 6 month thing, and it's going to get much better after that. All right, don't know how low we can go, but things are not going to stay this bad. All right, so that's where we are. It's adjustments like that, going rationally through your portfolio, position by position. And please, if you're in the chat room, feel free to put up positions and talk about what you have. Please try to format it properly so we understand what you're talking about, though. Because the thing that drives me nuts is when everybody decides they have their own way of talking about something. All right, it's like to say I have this many of this strike at this date contract, and it's also good to know what you paid for it, so we have an idea. You know, so we can just rationally have a discussion about it. I hate it when I have to go back and forth trying to figure out what it is you guys are writing. I mean, here it is. Or you see me do it all the time. It's like, it's very simple. I do, shit. No, I didn't do it here. Isn't that funny? Well, yeah, here. Oh, good. Okay, I didn't do the format. Isn't that great? I'm trying to say what you do. I mean, I didn't use the formatting here either. But still, I'm saying, look, the January 190, here's what I'm paying for that one. Here's what I'm paying for this one. Bear put spread, net 550, blah, blah, blah. You know, it's pretty damn clear what it is we're buying, what we're doing. 10 QQQ, April 175 puts for $5. That's how when you ask me about a position, you should be writing it. Then everybody knows what you're talking about. But if you have questions and you know how to format them, feel free to do it in chat. It's a good exercise for everybody to like talk about what your position is, how we could adjust it, what we think of the stock, so on and so forth. You got to go through your portfolios. You got to make sure every position is doing the right thing for you and is not wasting margin and space and so on and so forth. You know, the lower the market goes, sometimes you get hit with margin issues if you didn't keep mostly cash on the side, and that has to be dealt with too. And you have to plan on that. So you have to look and see where you're going to be exposed margin-wise and how much you have. Here, like I said, we have 85,000 in cash still. We didn't use that. We didn't do any crazy margining on the plays. So there's not really much change in that. We're going to have a vast majority of our buying power still available. So if the market drops 50% more, we're going to be very happy to double down on all our positions. And if the market drops 50% more and you double down on the amount that you spent, and all that would be is spending another $15,000 really in buying power, then boom, what happens? You're doubling the amount of positions you have. So when the market ever does come back, you're going to make double. Also, if you double down on your positions and it's flat, you get to sell half in calls and make an income stream to start bringing the money back in. So there's lots and lots of benefits to doing it that way. But the first step of the strategy, adjust your positions and make sure every one of them has a realistic target that you are going to be comfortable with. That is the first most important thing you have to do. That's step one. Step two would be adding 2 positions or adding more positions. Somebody asked me today, should we add from the watch list now? No, because exactly what we're doing here. I added these 3 positions because I'm only on the Money Talk show once in a while. Usually it's only once a quarter. They just specially asked me to come in today because everybody's freaking out. Not about the portfolio, but people are freaking out about the markets, and I seem to be a calming person for them. So we're going to talk about what's going on and what to do about it and so on and so forth, and use the portfolio obviously as an example. But also the watch list we had was a watch list we compiled when the market was still really high and there weren't many bargains around. So we were looking for deep value stocks. Not that those stocks are not still valid. We'll still look at them again. But now Caterpillar, IBM, GE, Ford, Cisco, Microsoft, there's blue chips that are on sale for ridiculously low prices. So screw the stuff I like. I don't care anymore. Go back to the blue chips. Go to the companies that are 100 billion plus companies and put money into those, because they're still going to be around even if things get much worse. They're the ones that are going to weather the storm. And that's where we want to focus on. Like, let's build a nice blue chip portfolio with cheap stocks. Oh, that's a good idea. Maybe we should do that. Let's make a crisis portfolio. All right, so put some cash on the side and we'll talk about doing that. That's a good idea. All right, any questions right before I go? I gotta run because I gotta get ready for this thing. TCNF is low. TCNF is low. That's Truly. That's my favorite pot company. That's crazy that they're so cheap. 1020 says people with 528 with the college plans are getting killed. Not me. I'm in cash. I said it 100 times, so I don't feel bad. I'm like, I constantly said I cashed out my kids' college accounts. I kept saying it. like I said, why would you risk your kid's college education on a potential downturn like this? Jean-Luc says, Phil, what do you think of Starwood? Back to 20. It seems like a decent price. Starwood, yeah, of course. But we don't know how much the virus is going to spread, and we don't know how long it's going to last. So people who are directly in the travel industry, I don't think I would jump into right now. They may start locking down airports, restricting travel, and that could cause a big leg down. If that happens, like if they shut, not if, they will shut Disney. When they shut Disney, that's when it's going to be time to start buying these guys, because then people are going to freak and things are going to go down. Oh, Disney, there's another blue chip we should be buying, right? How's Disney look? I mean, oh my God, what a sale, right? Oh, geez. I remember we had the short calls on these guys at like 135, and we were like, it was hurting us really badly for a while. You know, we had to roll these and get out of trouble with the stupid Disneys, and now they're like down to 104. It's crazy. But anyway, so I mean, these are incredible opportunities to get into these stocks, blue chip stocks for like incredible prices. So, you know, Star would know, even Disney know though at the moment, because they are going to shut the parks. They're going to shut the LA. They're going to shut California. They're probably going to shut Paris also. That's not good. Nobody's going to movies. They're probably going to shut movie theaters. They're probably going to officially shut movie theaters. They got to contain this thing, because it's going to overwhelm our healthcare system. We don't have the beds. We don't have the doctors. We have no ability in this country to deal with an epidemic like this. We just are not prepared for it at all, and we don't have the social safety net that would be required for people who are sick. There's so many poor people who are sick. 10% of our population still doesn't have healthcare. So 10% of the people who need medical attention aren't getting it at all, because they have nowhere to go. They have no ability to get health care. We created this situation in this problem. That means that 10% of the population, who are what you call the huddled masses, are going to be huddled together, sharing this virus in unsafe conditions, basically, compared to most people. And those people still come in contact with you. You step over them when you're going to down the streets in the city and stuff like that. These are those homeless people everywhere, all over the place. They touch things, they move around, they cough. You know, they're on the buses. You are not going to avoid these people. They sat in the subway right before you did. You know, if you don't take care of the underclass, this is what happens. And it's going to spread, and you've got 30 million potential patient zeros who don't even go to a doctor. They can't go to a doctor. They don't have a doctor. And even if you announce on TV, now you can go to a doctor, they don't believe you. They've tried before. They've had the copay issue. They've had this and that. They have learned in their lives that you're better off staying away from the whole thing. And then God forbid, by the way, if you're poor and you go to a doctor and the doctor says you have to go to the hospital, you are screwed. They take you from the doctor's office to the hospital, you're bankrupt. That's how a lot of poor people go bankrupt from this stuff. Because the doctor will insist you go to a hospital because you have something wrong with you that's serious. You go to that hospital, you don't have the ability to pay, they will hound you forever. They'll hound you right into bankruptcy. All because you went to a doctor because something hurt or something was bothering you. That's what poor people learn. Don't even go to a doctor. It's a trap. And I'm sure a lot of you have had the experience of going to a doctor, having to go to a hospital over something that turns out to be nothing. Except that we have insurance and we don't think of it other than some minor inconveniences. It's like, well, I'm glad I got tested because it wasn't a big deal, right? That happens all the time. Well, for poor people, that's not how it works. For poor people, it's like, well, I'm glad I got tested. Here's my $80,000 bill. You know, so therefore I'm now broke, and I'm going to be hounded for this for the rest of my life to pay up. That's our American healthcare system. So anyway, that's got nothing to do with Starwood. So Starwood, they're going to ban travel in a big way. So we're nowhere near that yet. So I don't think I'd jump right in. It's certainly something you want to get into down the road, but I'd rather be in Disney, frankly, and not now either. But when they close the parks, do you think they will look at changing margin requirements for the index futures given the huge moves? I would think so. I don't see how they can't. 5% a day. I mean, how do you not change the margin requirements? They assume that 2% is a massive move. Disney at 90? No, Disney's at 100, I think, at the moment. Anyway, all right, guys. Sorry it's a short session today, but unfortunately, I have a television audience waiting. But anyway, so stay safe, everybody. Holy cow. I mean, and again, like I said, let's review all of our portfolios very carefully. We already fortunately went over the portfolios last week, although now it's a pretty catastrophic couple of days. But we already went over the portfolios. It's very ugly as far as what's happening right now. I doubt this is the end. I think Goldman Sachs is now going to be proven right, even though they caused what they're proven right about. But this is a declared pandemic. Oh, what's a pandemic? Let's see. How do you know what a pandemic is? So that's a good question. Pandemic definition. Okay, define. Pandemic. Prevalent over a whole country or the world. Well, that's obvious. Okay, that's all it means? Oh, what's the difference between pandemic and epidemic? Epidemic is sudden increase in the number of cases. Pandemic is an epidemic that is spread over several countries or continents, usually affecting a large number of people. Well, didn't need that. Oh, I remember what I wanted to show you guys. Okay, wait, let's here we go. Okay, so coronavirus. So this is 226, 2 weeks ago. 81,000, 2,700 dead, blah, blah, blah. 81,000, all but 3,000 in China. Then last week, 94,000, there's 14,000 out of China. So it went from 3,000 out of China to 14,000 out of China, 3,200 dead. And now, this week, 121,000, 40,000 cases out of China, 1/2 of all cases out of China. Last week, 24,000 out of China, now doubled, 40,000 out of China, 4,300 dead, 6,600 recovered. That's slowing, that's not good. See, here we have 30, then we have 50,000 recovered, and now we only have 66,000 recovered. Those recoveries are slowing. How are the deaths doing? 27, 32, that's 20% more. 43, that's 30-something% more. More deaths, slower recoveries. That's not good. This is the worst thing, though. 40,000 outside of China is horrific. Look at all the people who joined the 1,000 Club. So I don't want to overanalyze, but I mean, look, it's like really bad. And 2 weeks ago, only South Korea had 1,000 outside of China. Now, 10,000, 9,000, 7,000, 2,000, 2,000, you know, forget it. So yes, pandemic, duh. You know, you really wait, this map, they couldn't figure out it was a pandemic, but now they see that it's a pandemic. I don't know. Anyway, so everybody stay safe. Really, it's I'd say on the whole, as much as people get the flu, we're all going to get the virus. I don't think it's stoppable. I think that basically, you know, just like the flu, millions of people will get it, but unlike the flu, a lot more people are going to die. And unfortunately, the flu kills, you know, 40, 50,000 people a year in America. And this is going to kill probably 10 times that many. We're going to lose like a couple of 100,000 people, most likely. And while that is horrible, it's not unrecoverable. It's, you know, it's just a thing that's going to scare people, and it's tragic, and a lot of people are going to die. But these things happen in human history on a regular basis. So, we're just going to have to weather this storm. And if you don't have any hedges, you should have hedges. We just added some QQQ hedges to the short-term portfolio today. But, either you need a lot of cash in your portfolio or a lot of hedges. And I know it might feel like it's late to a lot of people, but if you don't have hedges, you got to have some. You can't just expect this to stop. It is very, very likely we're going to go down another 10%, maybe another 20%. That'll be like 50% off the top. Okay, that's really, really ugly. And it's not going to be a quick recovery because these numbers are going to go up to incredible amounts. You're going to see, because China was just one country that went from 1,000 to 80,000. Now you've got 1, 2, 3, 4, 5, 6, 7 countries that are over 1,000 already, 8, 9, let's say 10. There's at least 10 countries that have 1,000, close enough to 1,000. They say it's 1,000. They're going to go to 80,000 too. There's no reason they're not going to have the same kind of growth and expansion of number of cases. So that now you're going to be talking about a million people infected, but it's probably going to be a lot worse because we can't contain people the way China can. So you're probably going to be talking about millions of people infected, and you're going to be talking about 50,000, 100,000, 200,000 people dying from this thing. And that's probably not even like the grim scenario. So it's going to be bad. It's going to not be done in a month. China took from 126. Wait. Here's 1,000. What the hell? It's hard to do. All right, here's China. That's 1,000 for China, roughly, right there. 124. It took them a month, not even a month, to get to 40, and then it had a big, huge jump. And they got to 80, and now it's flat, but people are saying maybe they're lying about this. We had 1,000 here, 218, not even a month, and we're at 40 globally. And then we're going to probably have the same kind of jump. But the problem is that unlike China, where they locked it all in a certain region, in China, they put a wall around all the stuff. They made these people stay home and all that. We're not doing any of that stuff yet. We're still going on planes and trains and automobiles. And I had this clip of Jimmy Kimmel people, interviewing people on the street, and they're like, it's no big deal. Trump says it's going to go away in a month or two. We're not taking it seriously enough. We're not doing enough for it. And all these dots are going to get bigger and bigger and bigger. So it's very likely to be a lot worse than it is now. And if this is the way the market's reacting now, what is the market going to do when that number is 1 million? When that number is 1 million, how's the market going to react? So do take this downturn seriously. Don't think it's going to recover quickly. Don't jump in and start buying things until you see a real floor. And these bounces are not real floors. You got to watch those bounce lines. All right, so sorry it's not cheerier, but this is a reality, and we have to face reality, especially when we're making decisions on our finances. All right, so I'll be on TV 7 o'clock tonight, BNN, which is Bloomberg News Canada, BNN.com, I guess, I don't know. And the show's called Money Talk. So I'll be on 7. I'm probably going to say the same thing I said now, more or less, except in a much faster pace. And I'll be back in the chat room tomorrow. Okay, thanks, guys.